Hey everyone, Rick Rodriguez with Fairway Independent Mortgage Corporation. I'm one of the sales managers here and the certified reverse mortgage professional. And today I want to show you one of the key aspects of the reverse mortgage loan. A lot of people know about a reverse mortgage and that it's used to eliminate debt, whether that be a current mortgage that one might owe or other types of debt-related items that they use a reverse mortgage to pay off those types of items. But also within the reverse mortgage, one of the ways that a consumer could take out the equity that they're qualified for through the program is a reverse mortgage line of credit. And today I want to go a little bit further into what a reverse mortgage line of credit is, how it works, so that you can see the power behind this, because this is really one of the features of the product that, number one, is not commonly understood by many out there, and number two, it really adds another component to what a reverse mortgage can do financially speaking for someone. So first of all, what is the line of credit? Well, it's similar to a home equity line of credit. So for those who have heard of a HELOC or are familiar with how a home equity line of credit works, it's similar in that a reverse mortgage line of credit can be set up where you have funds on standby. So in other words, they're liquid, and you have the ability to access those funds in a matter of 3 to 5 business days. The process is you would send in a request for whatever funds you'd like to withdraw, and those funds would be delivered to your bank account in a matter of 3 to 5 business days. So similar to a HELOC in how it's used to extract funds. Where it's superior to a home equity line of credit is for a couple reasons. Number one is a reverse mortgage line of credit can never be reduced or taken away from you. What I mean by that is with a HELOC, for example, if someone has a HELOC on a standby measure, meaning that they have funds in there, they're not really utilizing it. It's just there for, say, emergency types of purposes, right? They're not using it. The creditor could very well come back to you and say, well, because you're not using the home equity line of credit, we either have to A, reduce the line on you, or B, close the line, because we need to make those funds available to other customers who are looking to use the line. Secondly, there could be market conditions that could also cause the line to either be reduced or closed upon. A reverse mortgage line of credit is insured that it can never be reduced or closed upon as long as the borrower is meeting their obligations of the reverse mortgage, which the basic criteria for any reverse mortgage is, once you get it, you have to continue living in the home as your primary residence and continue making the payments on the property charges, such as property taxes, homeowners insurance, and HOA dues if applicable. So as long as you're doing those, as long as you're fulfilling those terms, then and you have a line of credit, then the line of credit, again, can never be taken away from you. So that's a huge difference with a HELOC. And then perhaps the even larger difference is that a reverse mortgage line of credit will grow each month and each year for as long as the borrower has the line, and of course there's a positive balance available in the line. And secondly, as long as interest rates are positive, then that line of credit is insured to continue growing for the life of the reverse mortgage. And the life of the reverse mortgage is as long as the borrower is living in the home. Unlike a conventional mortgage where you have a 15-year term or a 30-year term, a reverse mortgage is a life term. So again, as long as you're living in the home, that line of credit is going to be growing. And it's growing at the exact same rate as which the loan balance is growing. So that's an easy way to remember it, is whatever my balance, whatever my interest rate is on the loan balance, the debt that I currently owe, equals the rate that my line of credit proceeds are growing by. So it's always an easy way to remember it. So, and this is a compound rate. Let me add to that, because that's a big factor. It's not simple interest, it's compound interest. So this is compounding every month. And in the example I'm going to show you, you're going to see how that compound starts working over the years. So these are the basic criteria of the reverse mortgage line of credit, how it's different from a HELOC. And then what I'm going to show you is how, this is an example of someone at age 62, which again, qualifying for a reverse mortgage, you have to be at least 62 years of age. So this is someone right at entry level who took out a reverse mortgage line of credit to be utilized as just, again, a standby measure. What do I mean by standby measure? It's there, you don't have an immediate need right now, but you're setting it up in seeing that you will have some sort of need down the road, or you're just setting it up as a security measure to have another tool in your toolkit that is going to help you achieve a more successful retirement, which is the end goal, right, for all of us. So I'm going to show you how this line of credit works in an example. So in this example, we have a 62-year-old homeowner who takes out the reverse mortgage when the home is worth $600,000. Based on the age of this borrower, based on where interest rates are at this time, they're able to qualify for a reverse mortgage line of credit of $223,500. What we're going to show over time is year by year on the graph how this line of credit is growing. And again, it's growing because of the compounding factor, that is the interest rate which is charged on the reverse mortgage loan balance, what's owed, again, is the same rate at which the reverse mortgage line of credit is growing over time. So over the years, as you can see, this orange line represents the growth of the line of credit. The green line represents the value of the home and the growth of the home value. So over time, this line of credit is growing, as you can see. And right here at age 89, you see where it crosses the home value. And this is where we're now pausing and showing now. At age 89, this is under the assumption that this homeowner hasn't used the line, which if they use the line, perfectly fine. It doesn't take away from the value of the reverse mortgage line of credit strategy. But for this example, we're showing that this individual hadn't touched the line since they put it in place at age 62. So now at age 89, the line of credit has grown to $1,026,000 and change. At that same point, age 89, the home is estimated to be worth $1,024,000. So what it's showing is that the line of credit, by putting this in place, is actually giving this homeowner more equity available to them than just what's in the value of the home. And from this point forward, as you can see on the graph, that line of credit is estimated to continue to outpace the value of the home. Why is this beneficial? Well, number one is this homeowner is giving themselves an opportunity where they can actually have more money available to them through the reverse mortgage line of credit than just continuing to keep the home free and clear. That's number one. Number two is that if real estate would have gone the other way, if this graph would show that actually real estate went down, the line of credit, number one, continues to grow. So it's independent of real estate values, which is a very important aspect because a lot of other types of credit lines are based on the collateral. What is the collateral doing? Is it growing? Is it decreasing? A reverse mortgage line of credit is independent of what the home value is doing. So if that were the case, this is where the protective measure of this tool comes into play, is that perhaps maybe at age 89, the home's only worth $800,000 and the line of credit is $1,026,000. Protection. Secondly, is that at that point in time, even though the line of credit is larger than the value of the home, one could actually completely withdraw all the proceeds that are in that line of credit, which then get added to your reverse mortgage loan balance. So if you were to take this entire amount that's available, that now becomes the amount that you owe on your reverse mortgage. Good news is that even though by doing that, you would essentially go upside down, quote unquote. In other words, your reverse mortgage loan balance, what you owe, would be larger than what the home's worth, right? So essentially you're upside down, which for most other types of loans, number one, you can't do that. You can't go upside down. Number two, if you did, there would be some sort of issue with the loan. With the reverse mortgage, there is no issue in terms that it continues to work the way it was employed to work, meaning that there isn't any changes that one is going to experience when this situation occurs. And in fact, even at that, if you were to draw that, because reverse mortgages have an insurance that's attached to it, when the day comes that this borrower sells the home or their estate sells the home, and assuming that the home is upside down in the scenario that I was just depicting, the insurance takes care of that shortage 100%. So in that scenario, the homeowner was able to protect from home depreciation, increase their liquidity, and then draw more from their line of credit than what was available in the equity in their home without having any negative impact to themselves, without causing the loan to become due. Pretty powerful. Most people don't know about this and the line of credit aspect, how it works, how it could protect against home depreciation, as I mentioned here, how it could add another tool in the toolkit for retirement planning, and how it could also, of course, increase liquidity. From this increase in liquidity of what's available, you can obviously then have many more options made available to you than just keeping home equity intact. You can't do much with home equity until you extract it, right? Once you extract it, make it liquid, in other words, through this tool, then you obviously have many more options on what you can do with financial planning and retirement planning. Keep in mind that when you draw from this line of credit, there is no mortgage payments because it all falls under the reverse mortgage. And as you've learned from our video series along the way, hopefully you've been watching the video series, is that a reverse mortgage doesn't require any mortgage payments. You do have to pay property taxes, you do have to pay homeowners insurance and HOA, but in terms of a mortgage payment, that's obviously the big luxury of the reverse mortgage for many, is that you're able to borrow money from your home's equity without encumbering you, or in other words, without putting an additional monthly debt over your head that you have to make each month like a traditional mortgage. So because of that, now again, it gives individuals the ability to get further ahead in retirement by having access to this increase in liquidity. Now again, many more things that one could do for the end goal. What is the end goal? It's not about having as much equity in your home. For most people, of course, there's always case-by-case scenarios. What we have learned from experience, that what most people are looking to accomplish is to have a successful retirement. And what do we mean by that? Is having enough money to sustain you for life. In other words, not running out of money too soon. And a reverse mortgage helps to accomplish just that. If you'd like any more information on the reverse mortgage line of credit, reverse mortgages in general, please contact me anytime. Have my contact information there for you, flashing across the screen, I'm sure by now. You can reach me at cashflowsecurity.com. Call me directly at 460-6222. And I love talking about this stuff. So if there's anything that we can do to help you or a loved one better understand what a reverse mortgage is, how it can be used, and this tool specifically, please reach out to me anytime. Talk to you soon.